In other sense, you are using 1.6 million from this 32 million to generate 9 million sales. Guys, you understand? Nana, Momo, Paik, Vanessa, Tara and Meena, Noon, PD, Oliver,
Yes, sir.
and
Yes.
Priscilla. Good.
Yes.
Okay. Now, how to measure depreciation? Now we are going towards methods to calculate depreciation. One method we already talked about. We spread equally, but there are other methods as well. So let's just talk about that. How to measure depreciation? Number one, you must understand the cost, and costs include all the cost, all the money you have paid until first time usage of the asset. For example, if you buy an airplane, 32 million is the cost. Transportation cost would be added, installation cost would be added, inspection cost would be added, and then you come up with the cost. What its useful life? For example, 20 years, they have mentioned that. So that would be estimate. And what would be the residual value after 20 years? If you want to sell it for scrap value, the residual value means scrap value. So it would be sell, for example, 100,000. Because this is just a bunch of iron and some iron, that's it, and iron is not more than $100,000. Right? So it means its depreciable cost gonna be 32 million minus 100,000. This residual value, that would be the depreciable cost. All right. So let's just learn that. What is the cost? We talked about that. The estimated life, the length of service expected from using of the asset. So estimated life can be measured in years, can be measured in units as well. For example, how many miles it will fly. All right. How many units this machine will produce, how many copies this Xerox machine is going to be, producing. If this is a light bulb, how many hours it can illuminate. All right. Some other measures as well. Like I told you, how many hours it can consume electricity, how many watt hours it will run. All right. This kind of stuff. So residual value, also called scrap value or salvage value, if we want to dispose it with the cost of material, that's it. So how much is the value? That is called scrap value, residual value, or salvage value. Three names of the same thing. So what is depreciable cost? Asset cost minus estimated residual value. In some books, we call this scrap value. In some books, we call this salvage value, but here we call this residual value. All right. So that is the cost that is going to be depreciated, not the cost of the plant. All right. So let's just talk about that. So there are three main methods in which we find out the depreciation expense. Number one, straight line method. Number two, unit of production method. And number three, double declining method. Like we talk about in inventory, we have LIFO, we have FIFO, we have unique method, and we have average method. And it has different implication for profit and taxation purposes. Same happens here as well. If we are using straight line method, what will be the profit? And if we are using unit of production method, what will be the profit? And if we are using double declining method, what will be the profit and what will be the taxes? Of course, profit is linked with the taxes. The more you make profit, the more in absolute term, in dollar value, you have to pay taxes. So yes, there is a judgment involved in those three methods, or choosing of those three methods, if you are trying to minimize the taxes or if you are trying to maximize the profit. So we'll see that after learning what are these methods. All right. So we find out the cost of truck is 41,000. Its residual value is 100,000. All right. Its depreciable cost is, because 1,000 going to be recovered from the cost of truck. That's why this 40,000 is a cost that we cannot recover. Once we paid, cannot be recovered, because we are going to use that truck for 5 years to generate sales, or it will help us to generate sales. So we divide this 40,000 for 5 years, or its value, or it will last until 100,000 miles. After 100,000 miles, the value of the truck is just 1,000. And if we want to sell this truck gonna be sold on $1,000. So let's do that. If we apply straight line method formula is cost minus residual value into useful life in years. Remember, if we are using SL straight line method, remember the life would be used in years, not in units. So what is the cost? 41,000 minus 1,000 divided by 5, which means 40,000 divided by 5. Answer going to be 8,000. So that's going to be yearly, because these are years. Yearly expense. All right. If we want to find out monthly, then we further divide it with 12. So that is my point. Guys, you understand? So this expense is yearly, annual expense. Annual depreciation expense. So every year we charge 8,000 to income statement till 5 years. All right. So you see, if we make the chart for depreciation, the book value 41,000. All right. So what is the depreciable cost? 40,000. What is the rate? How we find out this rate? 1/5. 1 over life. Life is 5 years. Answer is 2. So this is the. So how much is the, how you record the entry? Depreciation expense to asset? No, because asset decrease, but we said that in depreciation we make contra account of depreciation, which is accumulated depreciation. All right. Why we set up this account? Because we want to know that how much in total the value has been depreciated. All right. So we make accumulated depreciation, and that accumulated depreciation will go to balance sheet, and this will go to income statement. All right. So if we make a chart of depreciation, this is 1 year, 2 year, 3 year, 4 year, 5 year. So you see, expense is 8,000, and at the end value is 1,000, which is equal to our scrap value or salvage value or residual value. So remember, the straight line method evenly distribute the depreciable cost to the number of lives, 5 years, and at the end the amount left would be exactly equal to our residual value. All right. So that's just, we talk about that. Asset final book value would be equal to residual value, and after that this asset is going to be disposed for 1,000 and we buy a new asset. That is what we plan for, until on year 4 or 5 we make a major engine overhaul, or we change the engine, or we change the body or something which increases the life of the asset. then the treatment gonna be a little bit different here. But we assume that right now at this moment, it will be sold at 1,000 and we get rid of, and then we buy a new one. All right. So during time to time, every year depreciation will go to income statement and accumulated depreciation will go to balance sheet. So every year accumulated depreciation will be increased until its depreciable value 40,000, not 41,000. Okay. So, for example, on balance sheet, how this truck is going to be written? Truck we purchased 41,000. After 5 years, the accumulated depreciation gonna be 40,000 and left 1,000. So this book value after 5 years shows the salvage value or residual value. And remember, accumulated depreciation cannot be greater than depreciable amount. Depreciable amount is equal to asset cost minus salvage value. Accumulated depreciation cannot be greater than 40,000. All right. So let's stop for a while and think about this illustration. So FedEx sorting machine that costs 10,000 with a useful life of 5 years and residual value of 20,000. So they purchased a machine for 10,000, okay, and after 5 years, this machine gonna be sold for 2,000. It means 2,000 gonna be recovered. So how much is the depreciable cost? How much the value we are going to divide per number of years? 10,000 minus 2,000. 8,000 gonna be the depreciable amount. All right. If we use SL straight line method for 5 years, so you need to decide for 5 years. So you divide it with 5. Answer gonna be 1,600, and this answer is per year because you divide it with 5 years. And if you want to find out the monthly, then divide this yearly with 12. All right. We will see in our illustration, the main illustration, then we talk about that. Now, unit of production method. Straight line method is fairly simple. Now, unit of production method is also fairly simple. But in that case, our depreciation expense is not evenly distributed according to the usage. The more we use, the more depreciation expense. The less we use, the less depreciation expense. So, the fixed amount of depreciation is assigned to each unit. Depreciable cost is divided by useful life in units. So per unit depreciation is multiplied by the number of units produced. So simple. You find out per unit depreciation, how many units you run the machine or truck. So you just multiply it with the units. So in our case, when we have truck useful life in units 100,000 miles. So how much is the depreciable cost? 41,000 minus 1,000 divided by, it means per mile, the depreciation is $0.4. So if the driver drive the truck 20,000 miles in 1 year, 30,000 in second year, 25,000 third year, 15,000 during fourth year, and 10,000 during fifth year, what would be the depreciation? So you write it down: 20,000 first year, 30,000 second year, fourth year, fifth year, and sixth year. You just multiply it with per unit rate. And did you see something? That the depreciation is not evenly here. Low, high, low, low,